Hey everyone, and welcome to this deep dive. Today we're going to be looking at inflation and gold and treasury bonds.
Interesting.
And specifically, we're going to be looking at some research from Quantpedia that looks at the relationship between those three and whether we can use that information to make some savvy investment decisions.
Yeah, it's one thing to just understand how those three are connected in a general sense.
Right.
But the exciting thing here is that Quantpedia is looking at whether we can actually use that connection to make better decisions as investors.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
And they did some really cool research where they looked at data all the way back to 1981.
And that's a pretty significant starting point because 1981 was the beginning of a really strong bull market for bonds.
Oh, well.
So any strategy that can show some serious outperformance during that period, that's really saying something.
Oh, yeah, for sure.
Yeah.
So let's get into the details here. What exactly did they do?
Well, they used ETFs to represent the assets. So we're talking about GLD for gold, IEF and TLT for treasury bonds, and SHY for cash.
Okay. And what was the big idea they were testing?
They were really interested in the rate of change of inflation.
Okay.
So their thinking was, it's not just about inflation being high or low, but how fast is it changing? Is it accelerating or decelerating? Because that's what really gets the attention of the central banks.
Oh, I see.
And then that has this ripple effect through all the markets.
Okay, so for example, like if inflation goes from like 2% to 4% and then jumps to 8%?
Yeah, exactly. That would set off alarm bells everywhere,
Yeah.
and the Fed would probably step in and start raising interest rates.
Right, and that's where it really starts to matter for like our investments and our portfolios.
Exactly, because when interest rates go up, that tends to hurt bond prices.
Makes sense.
But gold is often seen as a hedge against inflation.
Right.
So it could actually benefit from that kind of environment.
Okay, so we've got this inflation piece and how it impacts gold and bonds, but then Quantpedia took it even further, right?
Yeah, they did. They brought in this whole other factor, momentum, into the mix.
That's momentum in this context.
Well, momentum is basically the idea that an asset that's moving in a certain direction will probably keep moving that way, at least for a little while.
Okay, so like if gold has been going up, it's likely to keep going up.
Yeah, exactly. Or if bonds are trending down, they might just keep trending down, at least in the short term.
Okay, so they've got the inflation regime, is it going up or down? And then they're also looking at the momentum of gold and bonds.
Yeah, so now you can imagine there are different scenarios that can play out,
Oh, yeah, for sure.
depending on what's happening with inflation and what's happening with the momentum of each asset.
And so that's what they had to analyze.
Precisely.
I'm really curious to see how this all works in practice. Like, what does this model look like in action?
Okay, so picture yourself. You're looking at your portfolio and you're trying to decide what to hold.
Okay.
The first thing you do is you check the inflation data.
All right.
Has inflation been accelerating for 2 months in a row, or has it been decelerating?
So you're really watching those inflation reports closely.
Yeah, you got to keep an eye on them because that tells you what kind of environment we're in.
Okay, got it. What's next?
So let's say you see that inflation has been accelerating.
Okay.
Now you want to check, is gold also trending upwards? If it is, that's a pretty good sign that you should buy GLD, the gold ETF.
That makes sense because you've got the inflation environment and the market momentum kind of pointing in the same direction.
Exactly. You're aligning yourself with those prevailing forces.
Okay, so what if inflation is decelerating?
Then you would shift your focus to IEF, the Treasury Bond ETF.
Okay.
If inflation is cooling down and IEF is trending upwards, that's a pretty favorable setup for bonds.
So it's all about finding those sweet spots where the conditions and the trends are lining up.
Yeah, you got it.
Okay, so what happens if neither of those scenarios is happening? Like, what if the signals are mixed or neither asset has a clear trend?
That's when you move to cash.
Okay.
You can use SHY for that. It's a short-term Treasury bond ETF.
All right, and why cash in that situation?
It's basically a way to stay on the sidelines for a bit, preserve your capital, and just wait for a clearer opportunity to emerge.
So it's like a pause button when things are uncertain.
Exactly.
You know what I really like about this approach is that it's so systematic and data-driven.
Yeah, it takes a lot of the emotion out of the equation.
Right, you're not just going with your gut. You're letting the data guide your decisions.
That's one of the big advantages of using quantitative strategies like this.
But it's not just about being emotionless, right?
Oh, definitely not.
It's about being strategic and responsive to what's actually happening in the market.
Absolutely. This model is designed to be dynamic. It's constantly adapting to new information.
Which makes sense because the market is always changing, so our strategy should change too.
That's the key. You don't want to get stuck with a static buy and hold approach in a market that's always evolving.
So you're actively managing your portfolio, shifting between assets as the signals change.
Precisely.
Okay, so this all sounds really good in theory, but what about the actual results? How did this strategy perform in the real world?
Well, that's where things get really interesting.
Okay, tell me more.
So Quantpedia compared their strategy to a simple buy and hold portfolio of both gold and bonds.
Got it. What happened?
Their model actually blew the buy and hold out of the water. It generated an annualized return of almost 10% over the whole period.
Wow, that's a huge difference.
Yeah, it is compared to just over 6% for the buy and hold.
So significantly higher returns. But what about risk? Did all this complexity make the strategy more volatile?
That's a great question. And the remarkable thing is that the strategy not only had higher returns, it also had lower volatility.
Oh, wow. So it was actually less risky.
And it had a better risk-adjusted return, which is also known as the Sharpe ratio.
So it was able to capture more of the upside while limiting the downside.
Exactly. It's a win-win.
That's impressive. So it's not just about returns, it's about managing risk effectively too.
Precisely. And to make things even more interesting, this strategy actually outperformed holding any single asset class over the same period.
Oh, wow. So even better than just holding gold or just holding bonds.
Yeah, it really shows the power of this dynamic approach.
It's like you're not just betting on one horse, you're spreading your bets and adjusting your strategy as the race unfolds.
That's a great analogy.
So this isn't just a specific strategy for gold and bonds, the broader way of thinking about investing.
Exactly. It's about understanding how inflation and momentum can work together to give you an edge.
And it's backed by solid research and data.
Right. So it's not just some random idea someone came up with.
All right. So I'm sure people are listening and thinking, okay, this sounds great, but how do I actually use this information?
Well, the first thing I would say is go check out Quantpedia's full research article. They have it on their website, and we'll make sure to include a link in the show notes.
Awesome. Yeah, definitely check that out. And as you're reading through it, think about how those main ideas, the rate of change of inflation and using momentum as a signal, how you could apply those to other assets or even other markets.
Exactly. It's not just limited to gold and bonds. It's a way of thinking about the markets and using data to improve your decision making.
So it's about being more active and engaged with your investments, not just sitting back and hoping for the best.
Yeah, you got to stay informed and be willing to adapt your strategy as the market changes.
That's great advice. Well, it's been fantastic exploring this research with you today.
It's been a pleasure, and thanks for having me.
And to all our listeners out there, thank you for joining us on this deep dive. We hope you found it insightful, and we'll see you next time.